Hello and welcome back to the channel. So January was incredible and we have yet again topped our dividend record for a single month. So up to $112.51. If we compare that to my previous, highest month where all my large dividend stocks paid me and I received the most dividends, it was $100.61. It was my previous high for a single month. So that's an increase of over 12% in a very short time frame. This is just a single quarter, just a period of 3 months. And we can also see that even my lower paying months are higher than before. So now like my lowest is about $61 and before it was, 59, 53. Now our floor is rising for our lower paying months, and our high months are also increasing. So this is why what I really like to see from my portfolio. And we are also in the green in both my RRSP and TFSA. So if you want to follow along with the journey, you can leave a like, subscribe to the channel, and let's get started with the intro. So the portfolio value is now $21,186.03. So that's an all-time high for this portfolio. Our RRSP is in the green by 21%, or up 169.53, and our TFSA is up in the green slightly by 123. So let's go into my buys and sells. So in our TFSA, we can see that in the last month, we're up 9%, or up $1,682.96. This is why it's really important to stay invested in the market, dollar cost average, just make regular deposits, just continue building your positions, because you don't know where the stock market is going to go in any given month. 2022 is just a down year for everybody. And, if you would have sold out at the bottom sometime last year, you would have missed out on this little rally here. I mean, it's not really little. And, 9-10% is an entire year's worth of gains on average if you were to invest in the S&P 500. So it just goes to show, it can change at any time. And if you miss out on just the best days or the best months of the stock market, it severely impacts your returns, and that's why you need to be invested at all times. And if you want to get started, you can use my link for WealthSimple in the description below, and you can get started on your own portfolio, and you can receive up to $3,000 for making a deposit, and you do help support the channel. And all time, we can see that the portfolio has also rolled back into the green, so we're up 123.22, or up 1%. So that's nice to see. We were in the red for quite a while, but it gave us a great opportunity to build out positions in companies we really like. So Apple has rolled back into the green, and they're doing quite well, and they also had an earnings report. So let's get into that. So Apple's top and bottom lines weren't great. They came in a little under expectations. So $1.88 versus $1.94 estimated. So that's down about 10.9% year over year. Again, last year was very good for electronics, and it's a very tough comparable. Revenue is also a miss. So $117 billion in revenue versus 121 expected. So that's down about 5% year over year. But there were reports that Apple did miss out on roughly $4 billion of revenue just due to some supply chain issues due to China and locking down. So we can see that also impacted iPhone revenue. So that came in slightly below expectation. So 65.7 or over 68. And we can finally see that the Mac revenue, unlike the previous quarter being up 25%, it's now down 28%. So I think this is kind of normalizing. I think that the PC market in general is slowing down. I was really surprised to see that the Mac revenue was up in the previous earnings report, but now it seems to be kind of normalizing back to its normal levels. But that can kind of show that there's like a good difference between the PC and Mac market. the Mac is going to be affected, but it has its own set of customers that are kind of separate. If people are looking for a Mac, they're not looking at PC options. They're really locked in and stuck in the Apple ecosystem. So anytime they can sell like a piece of hardware, like an iPhone, a Mac, like the iPad revenues were great. Like those are up 30%. So I guess people really needed tablets this quarter over the previous year, because the iPad revenue was actually flat or even declining in the previous report. So that's kind of a nice surprise to see. So maybe a couple more people needing iPads. It could also be perhaps the increase in travel. So maybe people want to have like a device that they can watch movies on while they're traveling on flights and trains and boats and all that. Other products revenue is down 8.3, so that would be like your AirPods, other devices. Again, very tough comparables because everybody was just buying up, so it doesn't look impressive, but still solid numbers. And the services revenue actually was a slight beat, so a little 20.77 billion in services revenue, which is their highest margin revenue. So that's up 6.4%. And all of these people that are buying iPhones, Macs, iPads, they're all potential customers for the Apple services like Apple TV, Apple Music, Apple Fitness, or even the App Store. Pretty good to see. This is the segment that is probably the most important as they continue to convert more and more of their revenue to the subscription-based model and not as reliant on the hardware. But the hardware sales are still pretty strong overall. I just think it's a tough quarter for them. And the gross margins, despite many companies decreasing, they actually did a beat. So they continue increasing gross margins, which is nice. So they beat on that. Overall, I'd say that wasn't a fantastic earnings report, but it wasn't the worst thing I've ever seen either. It could just be a slowdown in the electronic cycle. They were impacted a little bit by supply chain issues. In general, not too worried about Apple. They can always continue increasing the services revenue, and they are rumored to have an AR/VR headset just around the corner, so that could be another avenue of growth. And they're very capital efficient company, and they're the only big tech company to not actually lay off any employees. So that's good for an employee standpoint, that they're not fearing for their jobs, unlike all the other big tech companies. So Algonquin Power still, kind of climbing out of the hole it was in. So it was in the low nines. Now it's nearing $10. So still a lot of uncertainty around this stock if the management can execute well and, fortify the balance sheet, convert the variable rate debt and, pay that down and have the majority of their debt be fixed rate. So ATD, I bought one more share of this company, so we went up to 13 shares. So I really like it at these levels. My fair value for it would be about 65. Again, do your own research. That's just my opinion, so no guarantee I'm right on the valuation here, but I think anything under 65 is a good price for a good return. Aritzia is also doing quite well. It's kind of just holding steady. I think people are just waiting to see more earnings reports before, investors know what to do with Aritzia, whether to bid it up or bid it down. But right now it's just, between the high 40s, low 50s, and it's just going to hang around here until we see some other, luxury retailers like maybe Lululemon or Nordstrom's, companies like that, see what their earnings are like. Of course, very exciting company with all their growth in the U.S. So we're just holding steady here. I think it's trading about at its fair value. I think it's about $50 stock roughly. Brookfield Asset Management has been, climbing out as well. So this is just the asset management part of the business. So this is just where they invest client funds and then they collect fees and they pay you a high dividend. Much higher dividend than just plain Brookfield, which contains all of their companies. So that's down 1.8%, but this was down at least 15% even just a month or two ago. So it's really climbed back up. Same thing with Brookfield Corp. And with Scotiabank, we did receive that dividend of a little over $25. So I reinvested that right back into the company, and we got ourselves about 0.35 shares of Scotiabank. All without having to do anything, just reinvesting our dividends and getting more shares. and then our next payout will be higher. So I'm just dripping the banks like that. So I'm just reinvesting the dividends back into themselves. But Costco, it's rolled right back into the green, so it's up 2%. I really wanted to get more at the 450s. It never got there. So it'll just remain to be a hold in my portfolio. I'm just waiting for that golden opportunity with Costco, but it seems to just never come. Unfortunately, this is always trading at a premium. Very frustrating because I do want the company, but I also don't want to overpay because that will lower my expected returns over time. We have our ENS, which is just our Enbridge Split Corp, which is just paying us 10% yield, and it pays monthly, so that's up 4%. Ethereum has kind of climbed out a little bit. It's down 52%. It's been holding, fairly steady here, but, not really expecting much of this position. It's a very small portion of the portfolio. It's less than 1%. It's more for, fun speculation than anything else, and spitting up little dividends here and there. And Google has climbed a little bit, but still down 12%. They also had an earnings report, which we'll get into. So if we just look at 2022 as a whole, Google reported that revenues are up 10% overall, or up 14% in constant currency, just because it's a global company and the US dollar has performed so well relative to the other currencies of the world that, it is affecting their bottom line because they're collecting those other currencies as forms of payment, and it's kind of impacting them. But overall, not too bad. So the overall top line revenue growth is there, but the operating margin not so hot. It is decreasing, so it went from 29 to 24%. And if your margins come down, it will affect the net income and bottom line, and the earnings per share, which is what you're really interested in as an investor. So that has declined from 2021 to 2022, quarter over quarter. The main reason why the margins are coming down so harshly is just the fact that, 156,000 employees to 190,000, Google definitely has a hiring problem here. Like, they are just hiring way too many employees. I don't know why they need so many. And they recently announced layoffs of 12,000 people, 12,000 jobs, and they still have more employees than before. And with a lot of these are not low paying positions. Like, the average salary at Google is extremely high, and the fact that they also have to give stock to their employees is also impacting shareholder returns, because that's taking away from other shareholders. When you have to issue more stock for these employees, you're diluting the shareholder. I know they are going to do buybacks, but it doesn't seem like Google is very efficient at optimizing, the appropriate level of employees for each of its business segments to run at the optimal level. And, I'm not the only person that thinks this. There's a lot of activist investors as well, so that have invested billions of dollars into Google, writing letters like, hey, Google is, YouTube is great. Google search is amazing. You have an amazing business with a strong moat. However, you have a huge problem in operating efficiency, and that's mainly just due to hiring way too many personnel. I do not understand why Google has this problem, but there are some positives in the report. The fact that Google Cloud grew from $5.5 billion to 7.3 is pretty good. That is not bad at all. So about a 30% increase in Google Cloud. And if we look at the operating results of the Google Cloud business, it lost $890 million in the previous year as of the end of the quarter. And now this year, in the latest quarter, it lost $480 million. So they're losing a lot less money in this business segment, which is really good. This is a high margin business. Once they turn this to profitability, it'll really help the company. I just think they really need to rein in on, at least on their employee hiring. I don't understand why this went up so much. And again, as a result of letting go 12,000 people, they're going to have to pay a bunch of severance packages of $1.9 billion to $2.3 billion. So again, when Google overhires and they have to lay off people, that's also going to cost them money. It's not good to the people either. I mean, it's just not good when a company overhires. It just doesn't help anybody. It doesn't help the employees because then they get laid off. It doesn't help the shareholders because then you're giving them stock, you're diluting existing shareholders, and you're also giving them large severance packages like this just due to your mismanagement of, what your workforce should be for all your given segments. So Google management really needs to improve in this aspect. So Google, it wasn't an impressive earnings report. I do like the progress that I'm seeing, that Google Cloud is still growing at a good rate and that their operating losses are decreasing and they're getting closer to profitability. So that's the positive. I like the growth in the top line revenue. Not happy with the margins coming down just due to all the people that they're hiring. It doesn't make any sense. It's really frustrating. It's like seeing, your favorite athlete just not performing up to the standards that that they're capable of doing. And, it's just disappointing as a shareholder to see them underperform in, just the management of just how many employees they need. And just if they were more efficient with their capital, I don't know, Google could go really, really far. There are also some fears that Microsoft is going to really threaten their Google Ads business with their AI, with ChatGPT, that's going to integrate into Teams. It's going to integrate into 365. It's going to integrate into Bing. It's just going to be a part of Windows. That's a real threat to Google search. So, but they did address that the AI was going to be a focus for them, and they're taking it out of their other bets category, and they're not going to be reporting the results that they're going to have with their AI department. So they should have a competitor to ChatGPT. I mean, they better, because they are definitely being threatened. And I did not expect Microsoft to be the one that threatened them, but here we are. So that's why Google is just a hold for me. I'm just waiting to see what happens. I don't know if they'll make it out of this one, but we don't really know what's going to happen in the AI space. It's way too early to call a winner right now. So Google's just a hold right now. I'm way more confident in Microsoft in general. We can see that Intel has, went down to 28, 27, just back up to 30 with this market rally. So people have very short-term memories about earnings. So even just a 1 week, and we forget all about those horrible earnings that we saw from Intel. So they have quite a few problems right now. So they're selling graphics cards at a loss because they have to build a consumer base. So whenever you want to build a new market or break into a new market, you often have to sell at a loss, just to get your foot in the door in that industry. So that's not going well. The data center is not going well because AMD is cannibalizing all the sales, because Intel's products in the data and server market are absolute trash. Nobody wants them. So Intel definitely has to make something good there. Their consumer products are fantastic. So their laptop, desktop CPUs, amazing. You can argue that they're the best, and they are. So I know they have the ability to turn this around. And once their fabs are finished and online, the foundry business should provide a nice burst of cash flow to this business. And they did announce that that they cut salaries for all the executives. The CEO took a pay cut, but also the employees took one, which I think is a little harsh. I honestly believe that the management should have been the ones taking the pay cuts and not the employees, because at the end of the day, as an employee, when you're working for a company, you're just doing what you're told, right? You're being told, move this object there, design this product, and you're doing that job. So I think that leadership should have taken the cuts, and I don't think that any of the employees should have taken that cut, because that's very demoralizing as an employee to just find out, hey, your salary is going to be cut by 5 or 10%. And it's not your fault. It's just because your manager did a bad job managing the company. It just doesn't seem fair to me. I mean, as an investor, it's great news, but I can't really see this being a good thing at the company, just because I know if you don't treat your employees well, you don't pay them well, that doesn't really lead to retaining top talent. In fact, that would actually piss me off as an employee. So Intel definitely has to do a better job fixing the issues it has. And this pay cut, I really, really don't like. It really irks me the wrong way. So hopefully Intel turns this around. I'd really like to see them be profitable again, but it could take several years. So I don't advise anyone to really start a position in Intel right now, just due to all the uncertainty. I'm going to just be holding my existing shares. They kind of have to prove to me that they can execute in the data center department, and also I need to see that that they're going to be better with their capital allocation a little bit, because it's not looking so great right now. And Microsoft has also gone on a bit of a rally, so they were at 240s, now they're back up to 258. Kind of unfortunate. I really did want to get a little bit more Microsoft, but if it's going to run up, there are other stocks, there are other opportunities in the market, so that's okay. So we're down only 5% in this position. Hopefully it dips again. I'm hoping the market pulls back. I really do want to get more Microsoft. With POW, they recently paid me a dividend of $13.37, and I actually just put that into TD Bank, just acquiring a bit more TD. And with TELUS, I just purchased 2 more shares, going up to 46. So I did have a goal to double my share count of TELUS by the end of 2023. So at each deposit, every 2 weeks I'm putting in, I'm going to be buying 2 shares of TELUS each and every time. So I hit that number by the end of the year. So that's going along pretty well. They've also rolled back into the green. TD Bank, I reinvested the dividend they paid me. So they paid me a little over $19. And I also used that POW dividend. So we got about a half a share just from dividend reinvestment, which is awesome. So about half a share of TD just from dividend income alone. And the big winner is Tesla. So, just a month ago, this was trading at 120. I decided to go from 2 to 4 shares. It's really paid off because it's shot up to 190. So one of the best performing stocks over the past month. And we're now in the green in our Tesla position. So the company is just going along great. People are really happy after the earnings. They feel really good about the company. The fact that they gave really good outlook that production was going to continue increasing at a 50% rate, and the fact that they can continue cutting down prices. It's putting a lot of pressure on their competitors to also cut their prices. But one thing that Tesla has that the other competitors don't is a profit margin on their vehicles sold. So because Tesla has, making 5 times the amount of money on the sale of a car, they can decrease the price of their car more and more and more. It's going to suffocate the other competitors, because if they keep decreasing their prices, they can't keep up. They have to sell things break even or at a loss, and that's just not a sustainable business in the long term. So Tesla just has a margin power. So that is their power. They have pricing power in the sense that they can outprice all of their competitors and make them unprofitable and make them go extinct. And in the RRSP, we're at 965.60, or down 2% actually in the last month. So not as great in this account. All time, we're up 21%, which is still very, very good. We started the account in roughly March of 2022. So I haven't had this account for very long. Only 2 positions. So we have StarBucks and SCHD. So I just did a little bit of a deposit. So I deposited about $10. We're just going to be putting it into SCHD, which is just 100 different dividend stocks. It's got solid dividend growth as well. Very good performance. It's actually outperformed the S&P 500 over the past decade. So great, and it gives a really, really great growing dividend. With Starbucks, we just have the 5 shares that I purchased, so we're up 25% in this position. And they also had an earnings report that I'll get into. With the latest earnings, it appears that in Q1 net revenue is up 8%, so up to a record 8.7 billion. So that's all-time a new historic record for the company, which is great to see. The comparable store sales are up 5%. So this is a very important metric for any a retail or restaurant business, is the fact that you can continue growing your business without needing to open more and more restaurants or more locations. So great. Globally, so that's 5% up globally, which is great. Up 10% in the US, so even higher in the US. So they're doing very, very good, optimizing their revenue in the States. and up double digits internationally, excluding China. So China was actually down 29%, but again, just due to all the things happening there, especially with all their lockdowns and just restrictions. It's not ideal for them. They have a lot of locations there. In fact, like I'd say Starbucks is doing well in spite of China. If China ever does, ease up on their restrictions, then, Starbucks will definitely be one of the many companies that will benefit from that. Starbucks especially would benefit from that. And the rewards membership reached 30.4 million users. So that's up 15% over the prior year, which is awesome to see because, this really keeps people, wanting to go to Starbucks more and more to get that, next free coffee. And they did alter their program a little bit. So it's actually going to take more stars. That's the point system that they have to redeem for a free beverage. So that could be a good thing for Starbucks. It could increase their profits even more because they're giving you a lot less for their rewards membership, but the engagement of that program is higher. And again, people are loading up these cards and they're giving Starbucks basically an interest-free loan. And, Starbucks is taking that money and making more money with it by, opening more locations. So that's fantastic. And, it just keeps people coming back again and again to Starbucks every single day, as part of their daily life. And they also said that they had kind of a surprise, maybe like a new drink or like a new product. So we're going to be seeing that coming up. So very exciting news for Starbucks shareholders. Overall, I'm very happy with this earnings report. I'd probably say that this is the best earnings report I've seen out of the companies that I own. The other company that I don't own that I really did like the earnings of was Amazon. That is on my watch list. That did decline. They didn't show like good profitability, but they grew a lot of segments in their business. And I was really happy with the results. So overall, not a terrible earnings season. A lot of our companies did, mediocre or bad or just okay. I'd say Starbucks was just, a nice little exception for there. They almost met their expectations. They just barely missed, but they're still showing growth across the board, which is really, really good to see in this tough market. And for the results of my dividends earned all time in the portfolio has earned $1,131.60 since starting it about 2 years ago. And annual dividends are up to $968.16, so it's up around $6 or so from the previous update. So nice little progress there. We got a little deposit, some dividends reinvested, and we're seeing this number grow. Monthly, we went from 80.16 to 80.68, so a nice little increase to our monthly passive income. Just going to be reinvested, further increasing our passive income, and then buying more shares and receiving more income. It's just going to continue over and over again, like an endless cycle of just dividends reinvesting into themselves. And then we have our weekly average went up by 12 cents, so from 18.50 to 18.62. Our daily average went up by a penny, so instead of earning $2.64 per day, I'm earning $2.65 per day. And the months to earn $100 has decreased yet again from 1.25 months to 1.24. So we can see there's definitely progress being made, making that $100 bill quicker and quicker each and every time we keep reinvesting and depositing. And then the hourly wage, if our portfolio was to work a 40-hour work week, so it went from 46 cents per hour to 47 cents per hour, and this number is just going to keep increasing over time. So great progress overall with the portfolio. I'm pretty happy with it. We can see that for 2023 so far, we've earned $125.88 in dividends. That's almost half the amount of total dividends I earned in my first year of investing, where I earned $261.80 for the entire year. So that's a very impressive start to the year that we've almost surpassed our first. We're like halfway to hitting our first year of investing in terms of dividends, and we should be passing our 2022. So I just want to see these charts keep improving over time, and we can finally, someday reach our financial independence as our income will grow to a point that it exceeds all of my expenses, and I will have the choice of whether I want to work. I won't be obligated to work, and that's definitely a dream of mine to have someday. So let me know in the comments below how your portfolio did in January. How much was your portfolio up in January, and what was your best performing stock? All right. So if you enjoyed the video, please leave a like, subscribe to the channel, and have a great day, everybody. And just keep investing. It may look bad from month to month. Maybe not every month is great, but there's also these great months that come along, and you definitely want to continue investing. Just make sure you have charts you're looking at. Make sure you're seeing that progress, because when I see these charts, they're very motivating to me to continue investing. And I also do like making these updates as well, because it kind of encourages me to continue growing the portfolio, because I'm held accountable to myself. And I'm sure you guys also want to see me like invest more and more and keep growing these dividends as well. So hopefully I can inspire some people to start investing, or at least keep at it so that they can reach their financial goals. All right, have a good day, everybody.